From WBRN Radio in Boston and on the Bostonred Network. Numbers, man. This is our macroeconomic program that we produce weekly with Cranston Analytics. Nonetheless, for the 8th of January 2018 is the program date. We'll be talking about the latest job numbers that came out on the 5th of January, which was Friday, and the effects there. The surge in Brent crude, petrol, the gas prices, how it affects the consumer. And we'll look at the market, which is up for the first 2 or 3 days. Does it really matter? The Trump tax cuts, too early really to say very much about those. We'll also look at some PMIs from the market people, U.S. PMI and a Eurozone PMI to sort of look at where the Eurozone is at the current time. First, we'll get to the employment situation and see where we are moving to. We'll also have some comments by the federal governor from San Francisco, Dr. Williams. And here we go. Nonetheless, this is dated on the 5th of January. Here, this is a household survey data. In December, the unemployment rate was 4.1%, 33rd consecutive month. The number of unemployed persons at 6.6 million was seasonally adjusted over the month and over the year. The unemployment rate and number of unemployed persons were down by 0.6% and 926,000 respectively. Amongst the major groups, the unemployment rate for teenagers declined to 13.6% in December, offset by an increase in November. The December unemployment rate for adult men, 3.8%, adult women, 3.7%, for Europeans, 3.7%, for African Americans, 6.8%, for Asians, 2.5%, and Latinos, 4.9%, showed little change there. Amongst the unemployed, the number of new entrants declined by 116,000 in December. New entrants are unemployed persons who never previously worked. The number of long-term unemployed who's jobless for 27 weeks, not 52 weeks, was little changed at 1.5 million in December, accounting for 22.9% of the unemployed over the year. The number of long-term unemployed declined by 354,000. The labor force participation rate, which we look at, that was much talked about in the 2016 campaign, 52.7% was unchanged over the month, and over the year the unemployment population ratio was unchanged at 60.1% in December, but was up 0.3% over the year. The number of persons employed part-time, for economic reasons sometimes referred to as involuntary part-time workers, was essentially unchanged at 4.9 million. Way too high, but was down by 639,000 over the year. These individuals who would have preferred a full-time work because they were unable to find full-time work. In December, 1.6 million persons were marginally attached to the labor force, about unchanged from a year earlier. The data is not seasonally adjusted. These individuals were not in the labor force. Wanted or were available for work, had looked for a job sometime in the prior 12-month period. Amongst the marginally attached, there were 474,000 discouraged workers in December. Little change from a year ago. The data not seasonally adjusted there. The remaining 1.1 million persons are marginally attached to the labor force in December had not searched for work. The establishment survey, these one of two, we just did the household. Total non-farm payroll employment rose by 148,000 in December. Job gains occurred in healthcare, 1/6 of the economy, construction and manufacturing. In 2017, payroll employment grew by 2.1 million, compared with a gain of 2.2 million in 2016. So, in other words, there were more people employed in 2016 than in 2017. That starts to put to rest some of the questions about economic programs. Now, next year, obviously 2019, we'll look at this once more. Manufacturing employment rose by 25,000, largely reflective of gains in durable goods industry, 21,000 there. Manufacturing added 196,000 jobs in 2017, while a little change, net change in 2016, minus 16,000 jobs. Employment in food service and drinking places, little change in December, 25,000 there. Over the year, the industry added 249,000 jobs, about in line with an increase of 276,000 in 2016. As you see from these figures, that 2016 was a better year. In December, employment changed little in professional and business services, 19,000. In 2017, the industry added 44,000 jobs per month, in line with its average monthly gain in 2016. Employment in retail trade was unchanged in December, a negative 20,000 jobs there within the industry. Employment in general merchandising declined by 27,000 over the month. Retail trade employment edged down in 2017 by 67,000 after increasing. Now, this is something we start looking at here very, very carefully, increasing 203,000 in 2016. So in other words, 2016 was the last year of the Obama administration, carrying over from 2015. Now we have to look at these years when we go from 2012, 2013, 2014, 2016, as we were coming out of the Depression. So that had something to do with it. But now we're looking at a totally different situation where we have the unemployment rate at 4.1%, but yet at the same time, we have not seen the growth in 2000, or did not see it in 2017. Let me continue on here. Employment in other major industries, including mining, wholesale trade, transportation, warehousing, information, and so forth, changed little over the month. Employment in other industries, including, we got that. Sorry about that. The average work week for all workers in private non-farm payroll, I'm not sure why they include that. That's something, a blast from the past, so to speak. 34.5 hours in December. In manufacturing, the work week edged down 1/10 hour to 40.8 temps. The payroll for non was unchanged at 33.8 there. In December, the average hourly earning for all workers rose by 9 cents to $26.63 over the year. The average hourly earnings rose by 65 cents, or 2.5%. The average hourly earning in private sector production increased by 7 cents to $22.30 in December. The change in total non-farm workers for October was revised down. This is not unusual to see these revisions, particularly in Q4. Was revised down 240,000 to 211,000. The change for November was revised from 228,000 to 252,000. With these revisions, employment gains in October and November combined were 9,000 less than previously reported. Not unusual here. After revision, job gains have averaged 204,000 over the last 3 months. Well, 204,000 is not bad, but if you look at the statistics from 2016 to 2017, 2016 was a better year. So we are working against that particular format, and now that we're in Q1, let me just move on here a little bit. Prices of, this is sort of a little summary here. Petrol oil prices edged up on a lower U.S. rig count, but below the highs. This is for Brent crude. We won't spend much time on it because we are moving very, very quickly on to Baker Hughes. I think what we'll do here is we'll edge on this. It's $67.77 per barrel. That was Brent crude futures, and it hit as high as $68.27. Let's just go past that and on very, very quickly here to stock market, treasury yields despite a jobs report. Now, this jobs report was not a very good report, particularly when you go year over year. World stock prices continue their strong start to 2018. The S&P and the NASDAQ posting their weekly gains. I would disregard that because, again, that is the beginning of a year and we really don't know very much about it. Throughout the first week of 2018, world shares rose and several benchmarks broke records. U.S. stocks closed higher on Friday with the New Year's holiday falling on Monday. It was the strongest first four trading days in more than a decade, 10 years there from the Reuters data. The Dow was the strongest since 2003 on the NASDAQ there anyway. Gains in Microsoft and the Google parent Alphabet boosted them. Well, again, that's sort of up and sort of down there. The Dow Industrials rose, 220 points, 0.47 points there. The NASDAQ Composite, added 58.67 there. We were up 2% the first 4 days of 2018. Markets are still working to figure out the implications of tax cuts, as Mike Biley, managing director at U.S. Bank Private Wealth Management in Portland, Oregon. European shares also had a good week. Treasuries, something we don't look at as much around here. 2-year yield held more than a 9-year peak. Investors stuck to their view that the Federal Reserve will raise interest rates multiple times this year, despite a weaker than forecast December non-farm payroll report. So we're still looking at that, and the dollar index 1.8 there. U.S. oil prices fell with production soaring earlier in the week. That was up, but that's sort of up and that is sort of down all at the same time. And this is from Reuters, incidentally. The U.S. Job growth slowed more than expected. Well, as we were just talking about it, many of these headwinds, particularly in retail trade, that was expected to happen, and you will see more of that because what's happened basically there, that was in December, a lot of those stores, particularly some of the Macy's stores, some of the Sears stores, would either close at the end of December or early January. So that we knew that was coming. We did not think that the today's employment report would keep the Fed from tightening at their March meeting, possibly so, and it depends. Job growth surged in October and November after being held back in September. So, in other words, you did have the weather-related activity in Texas and Florida, but at the same time, because of the hurricane damage, you had surges in construction. So it's sort of, we'll say, evened one sector out in our seesaw model. It did sort of go up and it did sort of go down, because historically in the winter months, you, especially in construction, you have less construction unless it's in the West. And of course, in the West, we had record fires, so we'll have some rebuilding out there. But that's family and perhaps some, mostly family, not multi-family structures out in the Los Angeles area and in specifically California. So that is a little different kind of situation. Prices of treasuries fell on the employment report. Employment gains in December were below the average of 204 per month. Well, that can be expected in December. It's below the year two. Job growth is slowing in the labor market, and near full employment could get a boost. Well, any boost that it gets from the $1.5 trillion tax cut package is temporary. In a separate report, the trade gap, we didn't report on that, but we'll do it now, widened to 3.2% in November to 50.5 billion, highest level since 2012. The deficit was boosted by record imports, which offset the highest exports in 3 years. The economy grew at 3.2%. Amortized in Q3. So you have your 3% there, but we come to we come to question, is in fact the 3.2% growth really actually growth? For all of 2017, the economy created 2.1 million jobs, below the 2.2 in 2016. Economists expect job growth this year to slow well below the 2017 monthly average of 170,000 in the labor market hits. So full employment. Well, if this is the case, a lot of it will depend upon these long-term unemployed workers and how they're integrated into the market. Because there are a lot of part-time jobs out there and people are moving around. If the labor market continues to be very tight in some areas, you'll have people obviously moving to different jobs that pay more. And that will be some displacement. What happens at the lower end, we'll have to wait and see. But again, when you're running 170,000 or less than 170,000, any slack you have out there, you probably are not picking up that slack. And at the same time, your labor force participation rate will continue to fall because of the baby boomers. And then you have a situation where you are, or if I should say the infinity, are you replacing these workers or you're not replacing these workers? Almost every person ready and able and willing to work now has a job. Well, that's not true. That's David Kelly, chief global strategist at JPM Asset Management in New York. Meeting a labor market demand will require hiring those less willing. Well, no doubt about that. In 2018, we've seen some of that. Are optimistic about the annual wage growth, topping 3% at the end of the year. The unemployment rate declines by 0.7% last year. We already talked about the jobless rate for African Americans fell below 6.8%. Economists believe the overall unemployment rate will drop to 3.5% by the end of the year. It would be the lowest since the 60s. Well, yes and no. There's going to be a lot of mergers out there, so you're going to have some, we don't want to say chaos, but you'll have something a little bit different here. Now, construction, yes, home building increased, 25,000 jobs, but again, there are some problems out there. Last week we talked about the National Association of Realtors there. General merchandising payroll, well, that we knew would happen. Sears Holdings said it's shutting 103 unprofitable Kmart's and Sears stores. Macy's 11 stores were going there, which leaves 5,000 workers unemployed. Unemployment retail trade is now its lowest it's been in 50 years as a percentage of total employment. That is from Eric Wingard, a senior economist at Alliance Bernstein in New York. So you are seeing a total different situation in a retail period. Another Reuters report on the jobs. We've already covered this, so we don't really need to spend a lot of time on it other than the most dire aspect of the report. This is from Bruce Doherty, a senior portfolio manager at Advisors in Minneapolis. The report is the loss of retail jobs over the holiday season. We might see record losses in traditional retail jobs in Q1. More closing. That's basically what we covered here. The market is struggling it off because it's not weak enough to detract the Fed from raising rates. The market thinks the number is not super relevant because of a tax reform related to salary increases and bonuses. I think, though, the yield curve would flatten more with the miss in payroll and the 30-year yield coming down relatively muted wage inflation there. And some more here. This is from Paul Nolte in Chicago at Kingsview Management. The market doesn't care, no doubt. The margin of error on these numbers is always big. I don't see it all that bad. What we are concerned about is if we see a couple of prints below 100,000. Employment and the markets should be good through the end of Q1, according to him. Jim Vogel, interest rate strategist at FTN. The number of jobs at 148,000 December were below the estimates of the group of 75. Well, yeah, no doubt about that. And in December, relatively expectations, considering the ISM manufacturing numbers, considering the Chicago purchasing way back a week ago. Anyway, wage growth saw a modest pickup, but we keep the yield at 2.5%. We won't go through all of these. This is incidentally from Reuters. Tim Simons, money market economist at Jefferies in New York. Payroll came in below expectation, but details are generally fine. Average hourly 0.3%. Wages continue to move in the right direction, although somewhat slower pace than one would hope at this point, as the slack in the labor force continues to diminish. Well, it is diminishing. It isn't diminishing. Factory orders rose in Q for the fourth month. New factory orders increased in November for the fifth consecutive month. They jumped 1.3%. That's from the Department of Commerce. Economists had forecast, 1.1 in November. Orders for non-defense goods, excluding aircraft, were seen as a measure of business spending, fell 0.2 in November. Instead of sliding 0.1, last month orders, so-called core capital goods, increased 0.8 in October. But there are problems. Shipments of core capital goods, which are used to calculate business equipment spending in gross domestic product, fell 0.1 in November instead of increasing 0.3 as reported last month. Business spending soared last year, as companies anticipated massive cuts in the corporate rate. The overall code, which most sweeping in at 30 was slashed to 21%. In November, orders for machinery fell 1% after rising in October 2.8%, but orders for transportation rebounded 4.1% after declining 4% in October. Orders for electronic equipment appliances rose 0.6%. This is from Reuters. Let me just get to Baker Hughes here. The count is on January the 5th. The count said 924. That is 5 down. In December of 2017, 29 and change from last year, 259 rigs. And in Canada, we had a plus 38 to count as 174. And actually, it's down by 31. Internationally, change from the prior count of negative 9 at 942. This is Baker Hughes, now part of General Electric. Anyway, nonetheless, plus 17 there from November of 2016. And I think we talked about Dr. Williams here, and sees unemployment dropping only slightly from 4.1. He's not going with he predicts to fall to 3.7. Some predicted 3.5. Will it matter between 3.5 and 3.7? No. The central bank lifted rates in 2017 3 times. The median forecast from the Fed sees 3 more hikes in 2018. That's more precautionary than anything else. Williams says the cuts should have a moderate positive effect on economic growth over the next 3 years due to consumer spending and business investment. He expects gross national product at 2.5% in 2018. That is in line with some. Some see it perhaps as less than that. The 3% espoused by the administration, it's going to be hard. It's going to be hard to do. It's in line with what the Federal Reserve has always estimated. The U.S. economy will be in a very positive place 2 years from now, and 2% inflation and 4% unemployment rate. Well, a lot of that will be out of a labor force participation rate and where that is going. Let me go back here, and we're going to do the numbers finally here. The BBC Global 30 on Monday, today down 1.0, not 7. These are Friday figures unless otherwise noted, and positive unless otherwise noted also. The FTSE All-Share at 16.89. In Amsterdam, they were at 4.10. In Frankfurt, the DAC was at 151.75. In Paris, 57.0, not 6. In Brussels, 39.21. And in Madrid, 97. In Zurich, 47.70. In Moscow on Friday, 9.81. In Johannesburg, they were down, negative 294.82. In Bombay today, 213.0, not 2. In Karachi on Friday, 615.28. In Lahore, a negative 45.11. That was on Friday. In Colombo, also on Friday, 55.07. In Tehran, Monday, negative 311.80. In Sydney, also on Monday, 6.07. In Hong Kong, in Tokyo, I'm sorry, the Nikkei, what am I doing here? Anyway, 2.80.2. In other words, 208.2. The Hang Seng in Hong Kong, finally, on Monday, today, negative 25.28. In Shanghai, on Friday, 6.0 and not 4. The Dow on Friday, 220.74. The NASDAQ, 58.64. The Merck, that's the commodities market out in the Midwest city of Chicago, 19.16. And in San Pablo on Monday, 1,046.17 in the negative. And in Mexico on Friday, negative 648.42. And on to Brent crude. Brent crude futures on Friday down 38 cents at $67.69. The spot was down, was up 23 cents at $58.59. West Texas Intermediate was down 47 cents at $61.54. T-Boone Pickens is jumping for joy. He remembers $15 a barrel oil. That was, of course, in the 70s. He's finally above that now. Anyway, nonetheless, gold on the Forex was up $4.20 at $1,317.90. Dubai Gold Futures was down $3.90 at $1,321.50. Silver, for those, I suppose, in silver, is up 3 cents at $17.16. On to your next life futures. For some reason, we like to do these. Cocoa, it was down $5. Robusta coffee was down $5. We kind of like to see that. And white sugar futures, for anyone that's into white sugar, was down 1.90. And the Bloomberg Commodity Index on Wednesday at 85.59 is where they were. So commodities, for the most part, weren't in too bad a shape. Brent crude is going to have to come down. There's no doubt about that. What it basically means is petrol, gasoline prices will go up because of where the futures are at this point in time. Not certain when the delivery date is on those. I suppose we could see. Usually it's 2 or 3 month here. Well, we don't have delivery dates. Anyway, occasionally we don't. To sum all this up, the job report for some economists was disappointing. I don't see why, because basically speaking, you had a disaster in the retail sector. Thousands of people laid off, stores being closed right and left. And also, if you look at the performance against 2016, 2016 was a better creating jobs year. Now, this does not necessarily mean that Q1, which we're in now, will continue to be where it is in terms of the unemployment rate, but number of jobs being created. A problem because you'll have more retirees. Also, we didn't talk about it, but the deficit must be extended on, I believe, the 20th of January, which is coming up here in about 3 weeks. Look at my calendar here. In the modern day, we always have these calendars around. Yeah, that will be coming up in about 2 weeks. We're on the 8th today, on the 20th, whatever. So that will have to be taken care of, and right now they're sort of at, I don't know if you really call it an impasse, but Congress is back there, and you have the Dreamers legislation stalled. You have community health center legislation stalled. The child care medical part stalled also. And then the administration wants to build a wall. So those are some things that are in there, and this has to be, the budget has to be taken care of. And the debt ceiling, I should say. And this is something that can't be done by a simple 51 vote margin. It has to be by a majority. So both parties will have an input in this. The administration has talked about a shutdown. A shutdown could be possible, but what will it accomplish in the political side? Nothing, because when you shut the government down, first of all, it has to be planned, and if you have, say, even a 3-day shutdown or a 5-day shutdown, it effectively takes a week or so to get the shutdown ready, and then it takes you'll be down for 5 days, and it takes another probably 10 days to get everything going again. So you have millions of dollars lost revenue, lost productivity time, etc., and then you have to measure the political costs. So all of these things are factored in where the markets will go. Effectively, the Reuters people, the people there, the economists or what have you, basically think no effect at all. In other words, the market is not paying attention to the jobs numbers or really any external factors other than the market itself. It's just pure speculation. Now, what this means is, well, we look at Intel in the tech sector. Their price has been falling because of the chip problems there, chip flaws. And we haven't looked very critically at Google. Google is one of those that are up. But just wanting to remember, the tech sector was up last year, and it was down, but it's still a very fragile sector in terms of delivery. So we will be monitoring of that. On WBRN, we'll have the open source report either today or tomorrow. We'll talk about the Intel chip flaw and the economic impact of it. And on our political program later tonight, we'll talk about the political side, where we are in the Congress with the the debt ceiling. Been very little activity about that, but again, that's something that must be done. This will do it for us. For those in business, make next week a productive one. For the consumer, the eye is on the ball. The consumers spent for the holiday season. There's probably not going to be a lot of spending now. Business inventories are not peaking up. And before we forget here, I almost forgot our PMIs. We'll at least go over. This is the Eurozone PMI let's see, the flash PMI at 58. November it was 57. The Euro economy gave it a forward growth momentum at the end of 2017. This is from the market people. Spurred on by near record expansion of manufacturing production and the steepest increase in the service sector activity in 6.5 years. The ISH market Eurozone PMI composite posted 58.1 in December. That was up from 57.5 in November to register its highest reading since 2011. That was after the Depression. Ireland remains at the top of the national output to PMI growth. France saw its pace of growth remain close to November's high, putting it in the second position. That's unusual because France had been in the doldrums. Trends in new business also strengthened in December. Manufacturers saw the steepest increase since April of 2000. Dr. Williamson, a stellar end to 2017 for the Eurozone, recorded off the best year for a decade, continuing to confound widely held fears that rising political uncertainty would curb economic growth. That's particularly in Spain. For 7 was the highest annual trend since 2006. Manufacturing is enjoying the best growth spell since data were first collected 20 years ago. The survey data is consistent with a quarterly rate of GDP growth acceleration to an impressive 0.8% in Q4. No sign of momentum being lost as we move into 2018. That's in the Eurozone. Hiring is consequentially at a 17-year high. Firms look to boost capacity to meet a rising workforce. Optimism about the outlook has also turned higher in December. While not accelerating in December, price pressures are running at as high as for 6 years as solidifying demand nurtures improved pricing power based on past experience. The extent to which demand appears to be outstripping supply for many goods and services suggests that inflationary pressure could continue to build in the coming months. A big question in 2018 will therefore be whether relatively high unemployment and spare capacity in many countries will continue to hold down pay growth and keep ceiling on consumer price inflation. A reminder that many of the wounds from a global financial crisis and regional sovereign debt crisis are still healing. Very important there from Dr. Williamson. Let me just grab, this is the U.S. PMI, service PMI here. Slow in expansion in business activity, not as rosy as the Europeans. Upturn in new orders remains relatively strong. Business confidence slips to a 15-month low. Now, December data signals a solid but a softer expansion in business activity across the U.S. Moreover, the latest upturn eased to a 7-month low in line with trends in output. The rate of growth in new business volume has softened slightly. Meanwhile, backlog continued to rise, and the latest expansion was the fastest in 4 months. Another solid rise in employment levels was linked to greater capacity pressure on the price front. Both input costs and charged inflation eased slightly with the softer activity. Now let's see here. So the output index fell to 54.1. That's down from 54.5 in November, despite acceleration upturn in manufacturing output. The composite index signaled softer growth following a slow expansion in the service sector because of business activity. The latest composite index was above the flash reading of 53, indicating a solid end to 2007, despite output growth easing to 6-month low. From Dr. Williamson again, he's the chief economist there. The final service and manufacturing PMI surveys collectively signaled faster business activity growth than the early flash recordings, but still indicates a moderation in the pace of expansion to the weakest since June. A welcome improvement in manufacturing output growth was countered by a slowdown in comparatively larger service economy. However, while moderating, the overall rate of expansion remains relatively robust. The economy growed at a solid 2 to 2.5 annualized rate in Q4. This is the U.S. economy. Similarly, hiring, while also slowed slightly at the end of the year, continues to run at a pace indicative of non-farm payroll up around 195,000 December as firms boost capacity with a rising demand. Now, this is very interesting here where they put it. The U.S. economy therefore ended, this is Dr. Williamson here, in 2017 with an encouraging score sheet, study economic growth, solid hiring, firmly inflationary pressures supporting the new view that interest rates will continue to rise in 2017. A note of caution is sounded by the deterioration in optimism about the outlook in the service sector to the joint weakest in the past 18 months. However, hopeful news of tax cuts and fiscal stimulus in 2018 will help revive business spirits and drive growth higher. Well, this whole problem of stimulus, and I guess you'd call this our little extended version here, is not the best. Now, if we look back at the market U.S. Service Business Activity Index at 53.7 in December, that's down from 54.5 in November. The latest index was higher than the earlier flash reading at 52.4, indicates a solid increase in business activity at U.S. service providers. A number of panel members suggested that the upturn was due to client demand, an increase in new orders. However, the overall rate of activity growth was weakest since May. It would have been in Q2. New business received by service providers continued to increase in December, abide at a slower pace. Now, this is the whole theme here, that these sectors are moving but at a slower pace. Meanwhile, outstanding business at service sector firms rose further in December, with a rate of growth accelerating to reach a 4-month high. Employment levels also continued to increase in December as monitored firms that reported a solid rate of job creation. Increased hiring was attributed to greater capacity requirements. That said, sales force numbers rose at the weakest pace since June. Inflationary pressures eased in December, with both input price and change inflation softening. The latest rise in cost burdens was attributed by panelists to higher fuel prices, and this is what we were talking about. Higher fuel prices in a tenuous economy such as the U.S. can kill the genie. Firms noted that the average change also rose solidly. Although the rate of inflation softened, it was above series trends. Well, no doubt, because of higher energy prices, and if higher energy prices continue into Q1, as we are in January now, but we look at February and March on these energy prices, and as we move into the spring months, if energy prices are still up there, it will start to impact this economy, particularly as we move mid-spring and the summer driving season. This will finally do it for us. Sorry we left those PMIs out, but it's very important to put them in. We like to look at the PMIs for an overview of where we are.